introduce and welcome Gautam Doshi, Vice President, Equity with Morgan Stanley. He joins us live now. Gaurav, good to have you back on ET Now. Thank you for joining us. What do you make of Friday's recovery? One is getting a sense that at closer to 5,300, 5,400, this market has a lot of fundamental support.
Yeah, I would think so. I think 5,300 is also the bottom of the range that we've been calling for, and I think Friday's recovery is something that hasn't surprised, because we did see a lot of skepticism in rollovers on Thursday. A lot of people frustrated. The cost of rollover was high. People weren't too bullish on the market. Consensus views that we were heading lower. So I think on Friday we saw a good bounce back on a lighter market. A lot of short covering that came, especially in the commodity and banking names. And even our view is that around the 53, 5,400 range, this market definitely has some fundamental value, which should bring in long-term money and provide support. I think at 260, 270, you may see fundamental value, but the problem is the hangover of, ad hoc policy by the government. I think that's going to impact sentiment, and, I think that's going to have a bigger impact on how the stock performs over the next 2 to 3 months, rather than the fundamental valuation. Even stocks like HPBP, we always tend to see value, but I guess, sentiment kind of gets the upper hand, and especially when we're at these levels in the market, and when you have a lot of other sectors and stocks which are equally fundamentally attractive, I would think ONGC would come lower down my preferred list. I'd rather buy a sector or a stock which has less sort of, skepticism in terms of policy that could potentially impact it.
So Gaurav, by that logic, would it be a complete no-no for the entire oil and gas space?
I just feel that oil and gas definitely warrants some amount of exposure in one's portfolio, but I think oil and gas is a sector that genuine long-term investors should be buying into. Traders will, get a lot of whiplashes based on news flow, and I don't think that that's really going to work out well. So yes, definitely, oil and gas, even though we would see a lot of value in it, I guess government policy is definitely going to keep that value subdued. I think it's hard to say if the risk trade is back on. I think commodity prices had a very sharp, severe fall, so we are seeing some amount of, pullback, some amount of stabilization come in at current levels. But all in all, if you actually think about it, I think, with the sort of flows that we've been seeing in emerging markets, I would continue to think that the risk on trade still exists. And, money hasn't really left risk assets. It's more like we've just seen a toning down of exposure there. So our view is that the risk on trade is definitely there and will continue for a little while longer. Unfortunately in this market, there's just more takers for a bearish call than a bullish call. So you saw kind of everyone jump onto that. But if you actually think about it, I think the market we're expecting a little too much from Tata Motors. I think, one is that the margin compression due to increased commodity prices was something that a lot of people were expecting, and it's not like that's something that took us by surprise. Secondly, in the auto space, if you actually think about it, if your market is getting concerned about a Tata Motors margins, you should be even more worried about a Maruti or a Hero Honda's margins going ahead. So in the auto space, we continue to prefer the CV makers like a Tata Motors and Mahindra. And honestly, if the capex cycle in India does increase, these two stocks are the best proxies for that capex spend increase in India. So we would actually be very constructive if Tata Motors or M&M were to dip and provide good entry opportunities. I think the private banking and the NBFC space has kind of really stood out. I think we've seen exceptional results there. And, I think individual stocks have kind of, sort of broken the trend from the broader market. So I think the small cap banks, even banks like Yes Bank, and moving to the NBFC space like LIC, GIC, Housing, or Bajaj Finance, I think the entire space looks extremely attractive. But more so, we also think the bigger names in the sector like HDFC, ICICI are due for short covering, which should provide further support to these smaller names. So if anything, I think, we would say with a lot more conviction that, these names, the smaller names in the banking sector or the mid-cap stocks there would definitely provide a good opportunity in this pullback. I kind of have a different view in mid-cap FMCG and FMCG stocks per se. We've seen impressive volume growth in these companies, but we do think that the margin trend will continue to be negative over the next 2 to 3 quarters, just because of the way commodity prices have been going up and the way competitive pressure and ad costs have been going up. And we tend to see money flow into these stocks when the market is nervous, when the market is skeptical. So under 55, 5600, I think these stocks would continue to, be in the trader's eye. But I think if once the market gets back into the momentum mood, and once we see, a sort of a positive bias emerge, I think these stocks will get forgotten. So I wouldn't really be chasing FMCG stocks as of now.